Hello and welcome again. Today is module 2. We will look into accrual and cash basis of accounting with more detailed, and we also look into IRS publications related to accrual and cash accounting, and to see if we can save something on the business taxes by going from one basis to another. Here is a link to IRS Publications. That's a very useful link. In these publications, you will need to look into two. First, let's do first things first. Accounting periods and methods. I've given you the link here. That's a shorter one. 538, recently revised. We will look into some useful information here. First of all, it discusses accounting periods. Most of the time you will deal with accounting periods which correspond to calendar year, but they also allow you to move that period depending on your circumstances. And they also provide a bit of a coverage for cash method and accrual method of accounting, as well as they give you some insights about inventories. Inventories is a complicated profit in taxation. So first of all of that is about taxation. Accounting standards are managed by US GAAP. In previous lecture, we discussed a bit about our transactions, and I introduced several different columns for transactions. 2 for accounting methods, accrual accounting and cash method, and 2 for tax based on cash basis accounting and tax based on accrual method of accounting. And these 4, they correspond from time to time and they disagree from time to time. That's why accountants always have some business to do. So let's move on. Accounting periods. So basically it's a calendar year or a fiscal year, which can be different from calendar year. If you happen to deal with an entity with a calendar year with a fiscal year different from a calendar year, you now know where to go to look for details. But that's probably enough to know by now about that topic, because most of the time small businesses and other businesses have calendar year. Only in rare circumstances they change the year. But that also some big companies also have different years. I believe Apple has a different year from calendar. Changing a tax year. So now we come to accounting methods. And in accounting methods, they say that what methods can you use? Generally, you can figure out the taxable income under any of the following accounting methods: cash method, accrual method, special methods of accounting for certain items, a hybrid method which combines elements of 2 or more of the above. And that's interesting. So we already know what cash method is and what an accrual method is. But what about special methods? So they say that, okay, we have a farmer's tax guide here. So if you are a farmer, your accounting might be different from accrual and cash method for tax purposes. If you do an installment sales, That might also be like a leases. If you're involved with the leases or other types of installment sales, you might have a different accounting. You might have a different methods if you depreciate property. For example, from time to time, IRS allows you to take a bonus depreciation, which is depreciation of the acquired piece of equipment, especially if you're a small business. They will allow you depreciate a piece of equipment in the year of acquisition, which is a great deal. I would say you will kind of save a lot of money on your taxes that way. I now see that my camera probably is not working, but anyway, okay, I am here with you. You hear my voice, no need to see my face. Let's continue here. Let me even zoom in a bit. So special methods, and they also refer to 535 Publication 535 business expenses, which is the other one we have here. And they continue on that you can generally use combination of methods, but with the following restrictions. And that's an important restriction for us. If an inventory is necessary to account for your income, you must use an accrual method for purchases and sales. See exceptions under Inventories later. Generally, you can use the cash method for all other items of income and expenses. See Inventories later. So if your business needs, if you trade inventories, if you sell inventories, if you resell inventories, most likely you will have to use an accrual method for that. That means that you will expense inventories only when you sell them. Okay. If you use cash method for reporting your income, you must use the cash method for reporting your expenses. So your income and expenses should use the same method. You cannot kind of use a cash method for expenses so that you kind of accelerate. No, let's say that you cannot use accrual method for your expenses so that you recognize them as soon as you can, and then you use cash method for your revenues so that you can postpone revenues as far as you can. So your revenue and expense methods must match. And same with accrual. If you use accrual for the revenues, you must use accrual for the expenses. And if you use a cash method, this must be a cash method. You can use, and again, it's a situation for your flow-through accounting when you are not taxed as a corporation, when you run a small business and all of your income and expenses, you calculate your business result and it goes into your individual tax return without being taxed as a business. In that case, your business income and expense might be on an accrual basis, and your individual income tax might be on a cash basis. If you operate two businesses, different businesses, they must be, if they are separate, really separate, you can run them under different methods of accounting. However, if you somehow use that to shift profits or losses between your businesses, then those businesses will not be considered separate and distinct, and you will have to kind of report it as a same business, and you will have to use the consistent method, either accrual method for revenues or expenses or cash method for revenues and expenses. Okay, what do we have here? Cash method. Most individuals, if you're an individual, if you receive a salary, you basically use a cash method. Your salary is reflected in your tax return based on cash method. And small businesses, many small businesses use cash method too. However, generally, if you use merchandise, you need to keep an inventory and use an accrual method for sales and purchases of merchandise. Let's see an example here, as we've already seen one. So here we have accrual method of accounting. Here we have cash method. So we basically expense the inventory with the cash method. However, in taxes, regardless of the method you use, you will have to capitalize that inventory, that merchandise here. Let's go back. Income. Under the cash method, you include in your gross income all items of income you actually or constructively receive during the tax year. Basically, they say constructive that when you receive cash for something, even if it's a prepayment, you have to recognize an expense. You have to recognize an income, even if you received a prepayment. Or if you rendered the services, you recognize revenue only when you get cash. And they have a constructive receipt concept here, which means that it's not have to be a hard cash. You can get a check, you can get a money in your bank account, or if you have some form of the agent or intermediary, which you have control over, and if that entity receives your money, it's already your revenue, it's your income. I remind you that's under cash method. So okay, we have an example here. You are a calendar year taxpayer. Your bank credited and made available interest to your bank account in December 2018. You didn't withdraw it or enter it into your books until 2019. You must include that income because it's constructively you have received it. Let's try to come up with an example here. Let's go to our example tab, and we will complicate a bit. We will complicate that example a bit. We earned an interest on CD in year 1 of, let's say, 500. Bank credited that interest to us in year 2. And we withdraw interest in year 3. Okay, year 1. Debit interest receivable 500. So that's an accrual basis. Credit interest income. What happens on the cash basis? Nothing happens because no cash changed hands. What happens for the cash basis of accounting? Nothing. So in year 1, the interest wasn't constructively received by us. So that's zeros. That's zeros. What happens under accrual basis of accounting for tax purposes? for tax purposes, we recognize it here. Year 2. We do not. I would say that when we got that interest available to us, we kind of debit cash. So we debit cash 500, we credit interest receivable 500. Here, if because we didn't withdraw that interest in cash accounting, we might not have reflected it yet. But in tax cash accounting, we recognize, and we have interest income here. So that is when we recognize that interest in tax basis. And of course, these are all zeros. Year 3. And only in year 3, when we withdraw, we might want to make it debit cash, credit, interest income. Sorry, here, yeah, interest receivable, interest income, all is correct. So this one will be zeros, 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 and only here we get cash and we get interest income. So that's a bit complicated example, and it's not very real, but that is a way how you can understand what's going on with the business and with cash basis, accrual basis, and taxes. As you might see, for accrual basis, we have like two entries here, while for tax basis we are mostly concerned with this one, because this is basically not cash entry, but we might also want to show that in the tax basis. So in that case, accrual taxation corresponds to our cash taxation. Let's see what else do we have here. Expenses. Under the cash method, you deduct expenses in the tax year in which you actually paid them. However, you need to comply with uniform capitalization rules, and we will take a look at it a bit later today. But what about expenses paid in advance? If you are smart, you might want to think that it might be beneficial for you to prepay a lot of expenses in advance, and that way you might want to kind of save on taxes, to recognize expenses earlier than you've done them. And for that reason, they implemented a capitalization rule. And they also implemented a special rule about expenses paid in advance. And it's called 12 months rule. Under the 12 months rule, a taxpayer is not required to capitalize the amount paid to create certain rights or benefits for the taxpayers that do not extend beyond the earlier of 12 months after the right of benefit begins, the end of the tax year after the tax year in which payment is made. So let's imagine we are in December 31st, 2020. December 31st, 2020. What amount of prepayments can we make to fully deduct in 2020 and our tax year ends December 31st, 2020? And the answer is we can prepay up to 12 months, assuming our right of benefit begins like January 1st. We theoretically can prepay 12 months through December 31st, 2021. And because our tax return ends on December 31st, 21, we will be able to deduct all 12 months. And we have an example here. If you are a calendar year taxpayer and pay $3,000 in 2018, let's see. Let me take a look at my camera for a moment. It doesn't look like it's working. So basically, if we are calendar year taxpayer, okay, I got back here. If you are calendar year taxpayer and pay $3,000 in 2018 for business insurance for 3 years, the general rule is that the expense paid in advance is deductible only in the year to which it applies. And so basically, if you do it on July 1st, you only apply half a year for the first year. And similar situation. You are a calendar year taxpayer and pay $10,000 on July 1st for a business insurance policy that is effective for only 1 year beginning on July 1st. The 12 months rule applies. Therefore, the full $10,000 is deductible in 2018. Let's see. Let's now make an example from that. Where is my file? Okay. It will be a pretty long example. So we prepaid $3,000 in 2018. We prepaid $3,000. So credit cash. We prepaid. And first we debited prepaid insurance. Okay. Попроси маму или бабушку поставить на зарядку. Sorry, my kids want his phone charged. I will be back in a second. Идем сюда. Okay, we are back. Let's come back to our examples. Видишь, ты там есть. Помахай ручкой туда в камеру. Все, дальше мультики смотреть. Нет? Okay, that's a benefits of working from home. So we have initially we have recognized a prepayment, and then okay, that's July 2018. Now we have December 2018, and on that point we will debit and credit something. So we will recognize insurance expense of 500 because it's only half year, and we credit prepaid insurance. We credit prepaid insurance for that 500. Okay, now let's look in the cash accounting. We will expense that immediately. I have a special account here for that purposes. I called it expense cash basis. Under tax accounting, we still recognize all the prepaids, and we only expense it. We only expense 500 in that year because of the 12 months rule. And for accrual basis tax accounting, we will also have the same situation. We will, if we move into 2019, we will record $1,000
Папа,
да.
а где-то вот это единые.
Эти, они показывают звук. Okay, so we debit insurance expense and credit prepaid insurance, and we will do basically the same in here. Что, пойдешь мультик смотреть? Или тут будешь? Тут будешь. Отлично. Okay. So that's the situation with 12 months rule. That's an example from the IRS publication. And here is a similar example. The only difference with that example is that we got only 12 months of prepayments. Let me copy all of that. Okay, let's see. We prepaid on July 1st, we prepaid 10,000. So we credited cash 10,000. We debited.
Вот эта кнопка.
Для работы.
Нет.
Стрелочка, чтобы управлять. Okay, then we got December.
Вот эта кнопка для того. Вот это.
Это, чтобы сделать заглавную букву. Okay, we got December. Initially, we recognized prepaid insurance. Then, on a monthly basis, we recognize an insurance expense, which will be half of that. Это пробел. Ставить пробелы между словами. Okay, we recognized an expense in accrual accounting. And the next year, we recognize the other half of expense too. And we reduced our prepayment balance. Now in cash accounting. In cash accounting, it will always be like that.
Вот эта кнопка.
Это чтобы на новую строчку переходить.
Не буду это сюда.
Okay, let's see.
Ведь с вами, ба. Я не хочу ведь с тобой.
Сыночек, я тут рассказываю людям тяжелые в понимании вопросы. Поэтому, если ты пришел посидеть, надо тихонечко сидеть, хорошо?
Хорошо.
Спасибо. Okay, so in cash accounting, we write off the total immediately. In tax accounting based on cash basis, we are also allowed to
Папа, да
write
я
that
вот
off
эта
immediately.
кнопка, вот это. Вот это.
Сыночек, я тебе уже говорил. Смотри, следи за этой штучкой. Благодаря нему эта штучка движется вниз. Okay, and if we use an accrual basis of taxation, our accrual basis taxation will match our accounting accrual basis taxation. So that's the part about here. Excluded entities. There are exclusions. Depending on your form of business, you will need to check.
Вот эта кнопка дает его.
Basically, you excluded.
Кнопка дает
Не
его.
знаю. Это чтобы заглавную букву делать. Basically, you are excluded if you have.
Папа, вот
If
эта
you
кнопка
have.
дает вот это.
Не знаю. Это кнопка Control.
А вот эта кнопка.
If for the last 3 years.
Вот эта кнопка дает его.
Sorry, I have to deal with that.
Вот эта кнопка.
Just give me a second.
Вот эта кнопка дает
Just
его.
give me a second. Это кнопка, Ваня, чтобы разного размера буковки печатать.
Туда я хочу.
Сыночек. Okay, I'm back. I'm sorry. It's a Saturday anyway, kids' time. Let's see. So if your company has gross receipts in average over last 3 years of $25 million or more, you cannot use cash. You cannot use cash basis. Or if you are a tax shelter, or if you are a partnership with a corporation as a partner, and the same threshold, 3 years, $25 million. Okay. Basically, you need to meet that gross receipts test to use a cash basis. So 25, you need to remember $25 million. And if you are in a farming business, you might have a different, you need to read separately on that. And there are a few situations whether you can use or cannot use that basis. Let's see what else do we have here. We have an accrual basis of accounting. And accrual basis for tax purposes most of the time corresponds to the to the accounting accrual method. But you might have most of the time for revenues generated or expenses incurred. However, from time to time you have transactions which will receive different treatment, especially related to acquisition and depreciation of fixed assets. You report amount in gross income on the earliest of the following date. When you receive payment, when the income amount is due to you, when you earn the income, when the title passes. And that's interesting because they say that you will recognize an income when you receive it, which means that they want you to recognize an income when you get a prepayment. And they say if you recognize some income based on estimate, if you adjust that estimate based on the fact in the future, you can adjust that in the year when you determined that there was a difference. Advance payments, that's an interesting one. That's where we can see some differences between accrual. So basically IRS wants you to accelerate the revenue if you received advances. Generally, you report an advance payment for goods, services, or other items as income in the year you received the payment. However, if you use an accrual method of accounting, you can elect to postpone including the advance payment in income until the next year. However, you cannot postpone including any payment beyond that tax year. For this purpose, advance payments must be includable in gross receipts under the method of accounting you use for tax purposes and included in income in your applicable financial statements. So basically they say if you use accrual basis, you can for both you can kind of postpone. You can elect to postpone including the advance payments in the income until the next year. Okay, financial statement. Any advance payment you include in gross receipts on your tax return must be included no later when the income is included on it, and applicable financial statements or other financial statements specified by the IRS section for additional information and the list of applicable. Okay. So basically what they say is that you need to, if you got an advance and you treat it as an advance in your financial statements under accrual basis, then you can postpone the IRS recognizing that advance in IRS revenues up to the time when you actually recognize the income in the financial statements. Advance payment for sales. Special rules apply to including income from advance payments or agreements for future sales or other dispositions of goods held primarily for sale to customers. Let's see if they have some examples here to consider. You are a retailer. You use an accrual method for accounting for the sale of goods when you ship the goods. Use that method for both tax and financial reporting purposes. You can include advance payments in gross receipts for tax purposes in either the tax year in which you receive the payments, or B, the tax year in which you ship the goods. However, see exception for inventory goods later. That's interesting. I will copy that to consider that for some practical purposes. Let's move on. Information. Exception for inventory goods. If you have an agreement to sell goods properly included in inventory, you can postpone including the advance payment in income until the end of the second tax year following the year you receive an advance payment, if on the last day of the tax year you meet the following requirements. You account for the advance payment under the alternative method discussed earlier. You have received a substantial advance payment on the agreement, and you have enough substantially similar goods on hand or available through the normal source of supply to satisfy the agreement. And they give you an example here, and I will come back. So that's a pretty complicated and unusual example. We will come back to it in the later sessions on the next modules. Let's finish that up. what about expenses under accrual method for taxation? Under an accrual method of accounting, you generally deduct or capitalize a business expense when both the following apply. The all levels test has been met when all events have occurred that fix the fact or the liability, and the liability can be determined with reasonable accuracy, and economic performance has occurred. So if you basically that accrual method for expenses, that it matches accrual method of the accounting most of the time. When they say that the liability is fixed, so basically that you can determine the value. You can determine the value most of the time. And the liability is fixed means actually that you kind of incurred the liability. For example, the vendor transferred the the vendor rendered you the services, and it's an expense. Or for example, you sold the inventory, and that's already happened. That's already. Sorry for a second, kids time. Сыночек, попроси, чтобы бабушка дала тебе финик. Okay, so basically for the expense side, for the income side, they say that the IRS wants some advances receipt to be recognized earlier, but they give you an option to recognize it later. And for the expense side, they mostly correspond to the accrual method of accounting. What else interesting do we have here? So we have related persons. If you engage in the transaction with related persons, it is possible if you use a various methods of accounting, like if they use a cash basis and you use an accrual basis, and if you engage in transactions which are kind of intended to decrease your taxable income, you will not be able to deduct those expenses. So that's that statement. And here we have recurrence, matching expenses with income, costs directly associated with the revenue of a period are properly allocable to that period. To determine the accrual of an expense in a particular year results in a better match with the income to which it relates. Generally accepted accounting principles are an important factor. Again, we have a 12 months rule here. An expense you pay in advance is deductible only in the year to which it applies, unless the expense qualifies for the 12 months rule. Under the 12 months rule, the taxpayer is not required to capitalize amount paid to create certain rights or benefits for the taxpayers that do not extend beyond the earlier of the following. If you have not been applying the general rule, an expense paid in advance is deductible only in the year to which it applies, and or the 12 months rule, you must get IRS approval. So basically they allow you prepay some expenses. Even under the accrual basis, they allow you to prepay some expenses if 12 months rule apply. And now on inventories. An inventory is necessary to clearly show income when the production, purchase, or sale of merchandise is an income producing factor. If you must account for an inventory in your business, you must use an accrual basis of accounting for your purchases and sales. However, see exceptions. Next. Okay, so we have exceptions. To figure taxable income, you must value your inventory at the beginning and end of each tax year. To determine the value, you need a method for identifying the items in your inventory and method for valuing these items. The rules for valuing inventory are not the same for all businesses. The method you use. Okay, so you must have the rules to value the inventory. But let's see what the exceptions are. If you are a small business taxpayer, you can choose not to keep an inventory, but you must still use a method for accounting for inventory that clearly reflects income. If you choose not to keep an inventory, you will not be treated as failing to clearly reflect income. If your method of accounting for inventory treats inventory as non-incidental material or supplies or conforms to your financial accounting treatment of our inventories. If, however, you choose to keep an inventory, general must use an accrual method of accounting and value the inventory each year to determine the cost of goods sold. And you use the 3-year average gross receipts of 25 million or more. We are running out of time now. Let's have a short break till 12 when we talk about homework. I will copy that exception because it doesn't sound conclusive for me in terms of whether they are talking about only incidental inventories like materials and supplies, or if they basically allow a small business taxpayer to deduct all amount of inventories. Because later here they say that you must include merchandise, raw materials, work in progress, and finished goods into the inventories. And later here they come up with the methods you should use to value your year-end inventory. Okay, so let's end up that stream, and I will see you in 10 minutes for the homework stream. Let's see if I have that one already scheduled here. Okay.